Hi, Anuj. It's great to see you. I'm sorry we can't do this in person, live. Looking at your new wonderful office, I haven't visited there, but obviously been to your previous offices. But obviously with travel restrictions, it's bit difficult all round. But for the benefit of the audience, welcome to Anuj Mittal. Anuj is the managing director and head of Europe for Angelo Gordon. He's someone I've known for, I guess it's about 11 years now, Anuj. And I was thinking when we first met, it was shortly after the last crisis, the GFC. So we've now had a global pandemic, somewhat different, but that's not the only time you and I obviously interact because we've known each other for a long time. But just really delighted you can join us today, and just wanted to get some of your thoughts on this new period that we all face, investing after the crisis. And perhaps we could just start with a snapshot point of how your team are. How are they less busy? Are they busier than they were pre-COVID? What's going on in the world of Angelo Gordon?
Sure. And it's a pleasure to see you remotely. I feel like we've all gotten pretty accustomed to having conversations this way, and I can't say I enjoy it, but I think we've all learned to deal with it, and it's not terrible. Maybe there's something in that for part of our discussion later in terms of will there be more of this. So in terms of Angelo Gordon Europe, we've been busy. 2020 was a year where we were probably acquiring 75% of what we typically do. So in a given year, we typically invest between 500 and 600 million of equity. It's what we typically are able to commit to new deals. We're typically selling a similar amount of equity owned in assets, but those are deals from 3 or 4 years ago that have been stabilized. So last year, we were about 75% of that in terms of new deployment, and we were probably about 50% of our sales pace compared to a typical year. And I actually was really surprised by that in a positive way. If you had asked me in June or July where I thought 2020 was going to end, I was not optimistic about being able to find opportunities to invest and being able to close on sales. But towards the end of the year, quite a few things came together. The team is busier than they were in 2020. So if you really compared March 21 compared to March 20, we were, of course, busy in March 20, but it was for very different reasons. It was much more of what the heck is going on here, where are there holes in any of our assets, what are lenders thinking, responding to our investors, and trying to be really good communication tools, both to our investors and to our other stakeholders, lenders and operating partners. It wasn't as much proactive as it has been this year. So this year, we've all gotten much more used to these kinds of conversations, understanding the new normal, and the team is much more productive in terms of the typical finding investment opportunities, fixing existing assets, and looking for opportunities to sell assets. So we are much busier than last year, and thankfully, I think we're in a position where it should be a pretty strong year, both for acquisitions and hopefully for sales.
Well, I do remember us speaking June, July, I think it was last year, and it was summer because I remember you commentating on this conservatory because the sun was streaming in.
Yeah, that's right.
But it was at a time when we were all kind of thinking, how's this year going to unfold? How long is this all going to take? And as you say, I think it's been quite remarkable how things, certainly towards the end of the year, finished. And we've seen the resilience of lots of businesses. I mean, many have been really challenged naturally in some of the sectors, and we'll talk about some of that perhaps in a moment. But what has been very clear from whether it's the business guys, the advisor community, the banks, people have generally been able to operate, not in the same way, in a different way, but businesses has been able to get finished and been able to get concluded. So, that's a positive. And, we definitely need to look for some positives because it's been a super challenging time for everybody in all sorts of ways. But you as a value add investor, I mean, often you see, in these disruptive times, there are opportunities for groups like Angelo Gordon to do quite well. Lots of people have talked about distress. In some cases, obviously, governments have supported the economy in all sorts of ways, so the distress hasn't been there. But do you see, as you look forward, opportunities for debt restructurings and opportunities in that arena?
Yeah, absolutely. I absolutely hope that comes about. As you mentioned, we haven't really seen that in any meaningful way yet, and there are lots of reasons for it. I think part of it is the stimulus and the support that governments have put in. And another significant part of that is just that lenders aren't sure if they want to be sellers or if they want to be holders of these assets. So, I think a lot of the lenders looked at the GFC and saw that groups that were able to buy debt and restructure assets did pretty well, and they don't necessarily want to be doing that again, handing profits to some of those debt restructuring shops. Now, that said, I think a lot of lenders will be forced to make difficult decisions as a result of values not being in a place where a borrower can refinance debt, or where a borrower doesn't have the capital to necessarily reposition an asset. A lot of these assets today just need to be rethought, whether it's an office building, certainly if it's retail, even logistics and industrial. There are different types of users that are pursuing these assets, and all of those changes require capital. And not every borrower is in a position where they have that capital, let alone the expertise or the patience or the fund life to pursue it. So I do expect that there will be restructurings, and a lot of it will come from the lending community or come from lenders who have assets. So far, the stuff that we've been able to buy still required a fair amount of capital restructuring, but it was often a seller who had a fund that was coming to the end of its life, or a joint venture that was in some form of disagreement, or complicated ownership between the ground owner and the building owner. So we still find that we're using our skill set of fixing the structure of an asset, not the physical structure, but the ownership or the financing structure of an asset. And we're reusing that muscle. We had used it in 2020 as those opportunities emerged and created some forced sales. And now we'll, for those assets, continue to use our asset management skill set to reposition assets. When I talk to lenders, this is the last comment, when I talk to lenders about their loan books these days, I think they will tell you that they have been very purposefully accommodative. This is really not like the GFC in that there was a big party and now there's, the hangover. This is really a natural disaster, and everyone understands that. If you were to take a temperature of those bankers today, March 2021 versus June 2020, I think what you'll hear from the lenders and the lending community is that they're starting to feel pressure from both the governments, the central banks, depending on the country. Some are a little bit more rigid, but also internally, a lot of the boards of these banks have decided that they need to be, they need to start taking reserves. Maybe they need to get out of certain businesses. Maybe they need to support borrowers that are really cornerstone borrowers for a bank. So I think they're making decisions to pull out of markets, pull out of certain types of lending, and maybe support only specific types of borrowers. And that will also play towards there being less debt capacity and availability in the future.
Yeah, they're very wise words. You can certainly see that happening because all businesses need to look at their own business, and there will have been a lot of government pressure to support businesses. And we've certainly seen that here in the UK, whether it's retail or hospitality or whatever it might be. And many of the banks, a lot of the work we were involved in was effectively, extend and pretend and waivers and all sorts of stuff like that. But at some point, that's got to come to an end because that kind of isn't normal operating. That's not a normal operating regime. And the banks, they've got their own shareholders and stakeholders. And at some point, they're going to need to sort of take a hard look at stuff. And I guess that's where, relationships are really important because those borrowers who have been very straightforward with their banks and manage their portfolios well, they will stand to probably do okay in this. And those who really, have not done that and been very challenged, then, you can see that there may be casualties. And I know your model, Anuj, is, and just for our audience, for those who don't know Angelo Gordon well, is very much a partner model, isn't it, with JV operating partners, and maybe you can just share some thoughts on that and how that's been successful for you.
Yeah, that is a cornerstone of our business. So the business was founded. The firm is 33 years old, something along those lines, which makes us a relatively old alternative asset manager. And from the very beginning, we founded the real estate business on the principle that real estate is a local business. So no matter how many deals we've done in New York City, which is where the firm is based, we will always do and make investments with local partners. And the same model is something we've exported to Asia, and we've exported to the UK and to continental Europe. And you from the very beginning have been very helpful in introducing us to some of those operating partners. Together, we've made a lot of investments and made money for our investors. The model is based on the principle of real estate as a local business, and then with that local partner, we can be a better digger for assets. We just hear about things through that network that are otherwise very difficult for an outside investor to hear about. We'll hear about a loan that might be in trouble because our partner's friend is involved at the valuation firm and knew that the bank was calling in various groups to have a discussion about alternatives. We'll hear about tenants that are relocating from one asset to another, and perhaps the lender doesn't even know yet that their tenant in one of their buildings had just signed a lease somewhere else in the city. And even though they have 3 years left on the lease, that's basically a known vacate, and that asset will need to be repositioned. And so that sort of information is really helpful in terms of us identifying opportunities. And then once we've identified opportunities, really identifying how to fix that asset relies on that local network and that local partner's expertise. So it's been a great model for us globally. And today in Europe, we have about 40 what we call tier one operating partners. So groups that we've done investments with and are actively pursuing deals with.
That's really good to hear. I mean, one of the things that's looking like we're going to face on the horizon is inflation. And there was a lot of stuff in Weekend FT about that, and what's happening in the public markets and bond yields and stuff like that. How do you think that might affect your activities and your approach and outlook and the investment landscape generally for real estate?
Yeah, it is. It's one that I never studied economics, I guess, in school, or maybe I did, but I don't remember any of it if I did. And after the GFC, I think there was a lot of the worry that by governments introducing so much stimulus, you're going to see yields rise. During the GFC, there was a lot of stimulus pumped into the world, and we didn't see yields rise or borrowing spreads rise for governments. I think with this natural disaster, those same bankers sitting in central bank positions knew or thought that they could create a lot more stimulus, and similarly, we wouldn't see rates rise. We are now seeing rates rising, and you're seeing it in the U.S. more than anywhere else. So what does that mean? It might mean that we were wrong after the GFC, and unlimited stimulus does have a consequence, and it does require a higher borrowing rate or higher interest rate for someone to take on all that debt. It could also mean that the world is starting to look at inflation, as you mentioned. They're starting to believe that all of this money will create inflation, and therefore there's a higher opportunity cost for that debt. In terms of what it means for real estate, inflation, as long as it leads to rental growth, is a good thing. Inflation means that the economy is moving and there are more jobs being created, and more jobs means more physical space being needed, and more physical space means rents go up. Perversely, as rates rise, and if it is leading to rental growth, cap rates often come in. People will pay more for an asset on a cap rate, knowing that they can underwrite real rental growth. Now, that's the key. Is there going to be rental growth? And there are certain asset classes where that seems more obvious. Residential, logistics are places where there's some real structural headwinds that might create more of an uplift. Offices is a big debate, and I won't rehash those debates. I am a believer in the office for the right offices, and I think there will be rental growth for the right offices and the right locations. Retail is more challenged, traditional shopping center retail. So overall, I think this inflation, reinflation of the economy is a good thing for real estate, and it will probably be concentrated in certain asset classes that have a structural advantage in that there's more demand.
Well, seeing you there with the backdrop of Amsterdam in your office, and again in the papers over the weekend, they were saying Amsterdam is the favorite city in the world to live and work in terms of balance, although I'm not sure you've always had balance, Anuj, because in the nature of private equity, it tends to be pretty full on. But interesting your remarks on the office, because there's been a lot talked about that, and clearly you've heard Goldman Sachs, you've heard some of the investment banks, JP Morgan, and I agree with you. I think for what it's worth, anecdotally in our own office, We have a lot of people in London. There are a lot of people craving to just be back in the office for all sorts of reasons. For learning, for experience, for variety, for meeting their colleagues. And actually, it's very important for the younger members of the team, because that's how they learn from being amongst people. It's pretty difficult to just do that on a screen all day. But inevitably, I think there will be a blend. The issue won't be, I mean, you guys can cycle to work. You're very fortunate in some ways in Amsterdam. In London, it's public transport. And that's the issue, I think. It's getting people feeling safe, getting on the trains and stuff. So we'll have to see how that pans out. But there generally feels like a huge amount of interest in getting back to the office and seeing friends, and it can be much more efficient. So yeah, it'll be interesting to see. But what about strategy and for AG, and in the short term and then to the longer term? How do you see, and what do you think the new normal is going to look like?
So I think the new normal, well, I don't know exactly, right? None of us are really have a strong view of it. I think we're trying to do, and probably using your example of, are you going to go back to the office? There's a lot of data gathering right now where you're trying to make the best decision based on the feedback you're getting. And that feedback will evolve as people get vaccinated, as people try out working from home 2 days a week and realizing they might want to do one more day at home, or might realizing they don't want to be at home 2 days a week, or realize that they're on this conference call. The two of us are, imagine we were both live and one person was joining by screen. I think it's a lot harder for that third person to feel like they're participating in that environment. So to be able to say today how those threads will end is really difficult. But I think we do know that people continue to want to be in environments that are vibrant. When they go out of their office building, they want to be near things that are interesting to see and eat, and they want to be near theater. They want to live near places where there is theater and there are arts. You want to work in office environments that are beautiful, that want you to come to the office because it's really efficient and functional and everything just works. Those sorts of things I think are true, and will probably continue to be the case. Urbanization is one of those mega trends that I just don't think COVID will stop. I do think there are some repercussions of COVID where we've been in this long enough that we've also made some realizations. Like you said, you might want to work from home. You'll prioritize that 1 day a week or 2 days a week for some people, not at all. And for some people the entire time, but for the vast majority of people, they see the advantage of having that temporal flexibility, whether it's driven by family or other things they want to get done during that day at home. And you're probably going to see more of that. So I think that's a fairly permanent change. You probably will see less business travel, so what that means for business hotels and conferences is something to think about. Again, that's our thought right now, but it could change as we get more data and more behavior changes evolve. In terms of your question of strategy, we have always been a very bottoms up type of firm. So imagine Angelo Gordon as a small group of people carrying the Angelo Gordon business card, but with very wide networks. Those 40 operating partners probably represent a few hundred people that are boots on the ground in these markets, helping find opportunities. So I could tell you right now, we don't like shopping centers and we'll never buy a shopping center, but then a great shopping center deal comes around through that bottoms up network, and it probably has a higher bar than other asset classes, but we would absolutely consider it. There are no really red lines for our strategy. That said, we have views, and I think like a lot of our peers, feel like the asset classes with the most resilience right now are in that shed and bed space. I do think some of it's also being overbought, but those are spaces where your residential apartment doesn't have an obsolete floor plan, unlike maybe a office building. So those are places where you can feel more confidence. Logistics for the e-commerce trends are very strong. You are seeing self-storage as a resilient business. So there are a few places where when we've been making bets along those lines, alongside the bottoms up and what filters through.
Yeah, and the other area of interest I've seen from many investors, you've mentioned bed sheds. Clearly, that's obviously been super hot. You know, everyone gets an Amazon delivery every now and again, and of course, yeah, the yields and the cap rates on those kind of investments. I know that's not necessarily your stock in trade because you're all about repositioning and more value add than plain vanilla stuff. But life sciences has come up with a lot of people. You know, clearly after the pandemic. There's a lot of focus on R&D and research and labs, and I know you've made some of those investments in science parks yourselves. And any thoughts on that?
Yeah, I think it's a good one, a good thing to mention. I should have mentioned it as well, but I think life science is a really interesting place right now. So the question could be posed as if you knew what the internet was going to do to the world in 1985 or 1990, what would you have done as a real estate investor? And you probably would have gone to Silicon Valley, and you would have probably bought things in Boston. And the analogy is being made that today life science is like that. Biology is at a point where whether it's bespoke medicine or it's other applications of biology that can be monetized, that is the segment that's going to grow dramatically. So as real estate investors, what should you be doing if you think that's the trajectory? There are places like Boston and Cambridge that are very well trodden over by life science investors and by real estate investors. I think that section, that world of science and innovation is still one that has a lot of room for growth, and particularly on the continent. So we are looking in continental Europe to see if there are opportunities to bring to small hubs a real professionalization of their real estate. So can you go to a cluster of science users and really be a partner of theirs? Can you create lab space that is modular and easy for them to move into, to scale up? Can you create a environment that encourages seminars and innovation and puts different groups in contact that otherwise might not have been able to be in contact? So I think it's a really interesting sector, and one that I particularly like because as a real estate investor, you can be additive to the business that these tenants have. It's not just a vanilla office building where on one floor, you have a law firm, and on the other floor you have a trading firm, and they never interact. By designing these buildings well and really curating the experience and being an active owner, you can help these businesses do better. Very exciting space to be in right now.
Well, I'm interested to see, obviously, how things are going on the continent. And when I first got to know you, you were based, obviously, in the UK. And that was kind of 10, 11 years ago for a number of years. And obviously now back in Amsterdam. But, we've obviously had a pretty challenging period, particularly in the UK with Brexit and everything else. Clearly overtaken by the pandemic and everything that's brought with it. But obviously with Brexit done or nearly done, subject to the financial services deal, etc. And obviously Amsterdam seems to have been, going gangbusters in terms of rental growth. Lots of people have been looking at Amsterdam for the last 24 months, 36 months, where you're based. But what are you sensing from your own investors, and what's your own thoughts on the UK and Europe, and where the capital is going to flow to? Are there particular markets and sectors that, we've talked a little bit about sectors in terms of logistics and life sciences and resi, but in terms of markets, do you see particular interest in continental Europe or the UK? What's your sense of all of that now?
Yeah, I've been surprised with how, and not surprised also, but after Brexit, and we're in the last innings, I hope, but I've been surprised how resilient London and the UK has been in the minds of a lot of institutional investors. When Brexit was first announced, I really thought, oh no, this could be a red line for a lot of those core funds and sovereign funds. But the reality is that London has gone through, and the UK have gone through bigger things than, the Brexit, and people recognize that, thankfully, and they realize the strength of that economy. There is a knowledge sector in London that is, I think, impossible to really replicate anywhere else in Europe, just the talent in terms of the legal minds and the financial business minds and the technology and media minds that are there. Not to take away anything from other cities, but the concentration there is pretty remarkable. And I think people understand that. So a lot of that forever money, that the groups that are permanent capital that just want to own things for a very long time realize the strength of London and the UK and are continuing to buy there. So we've been very positive, even through Brexit and all of the last few years. We've continued to be investors in the UK, and I think it's suited us really well. There were other groups that said they're not investing until Brexit is clarified, and I think they missed out on some great opportunities, both to buy things, but also fix assets and sell assets. So it's going to continue to be a big part of our strategy. Historically, it's been about 50% of what we've done has been in the UK. It's sort of tottered between 40 and 50%. I think it's probably going to come down in terms of our allocation pie, just because our pies are getting bigger. We're investing bigger and bigger funds. But I think it's going to continue to be one of the most dominant markets. In terms of other areas that seem to be interesting, both for us and institutional investors, one area that has grown more significantly has been in the Nordics. I think you're seeing more investors in the Nordics recognizing that as a region, it's a pretty significant population and pretty significant real estate market. There also are some really great innovation leaders there, sciences, but also media and technology. And it's a place where there is a transparency that gives people comfort that they can do business, even if they're not local. So similar to the UK, foreign investors really feel comfortable there because of just the transparency and caliber of the professionals, and you also see that in the Nordics. Germany continues to be very hot. I find it to be a more domestic market, even though it's such a large market, but it's still dominated by such large domestic players that I think operate on a very different set of rules in terms of just how they perceive risk and cap rates, and are very, very happy to pay, I think a logical amounts of money for perceived security. So a long-term contract to a questionable credit will get a cap rate in Berlin that you really scratch your head at. But you can't fault them at all, because the prices have continued to go up, and I think everyone has been very happy with what they've bought to date. But that market is a harder one, I think, for foreign investors to be able to step into.
So I know, Anuj, you historically, you've traveled a huge amount in the nature of your role and your job, whether it's seeing investors in the US on fundraisings, or whether it's doing transactions and making investments. In the world we now exist in, and clearly at the moment there's a lot of restrictions around travel. I think you mentioned you would probably be doing less, but is it going to be an impediment to some of the international investors because people like to go and see buildings, touch them, feel them, kick them, etc. I guess your model is pretty good in that regard, because you've got local guys on the ground as part of your JV partner model. But how do you think that's going to affect the markets? And aside from you, where I think you're well positioned, what about some of the other investors? Is that going to mean transactions, for example, in investments during the rest of this year are going to be somewhat more subdued until we sort of start to emerge from this?
Yeah, I think that's probably right. There's a level of investing you can do remotely, but really to go, buy a big building, you want to walk the neighborhood, and you want to, of course, walk the space. Maybe you want to interview some of the tenants. So I think that's going to be a necessity. Every deal that we've been doing this year, every LOI would have, exclusivity clauses that say we have this amount of weeks, but we can extend it by X amount of weeks if we can't go visit it. So there often are links to being able to visit the asset. But I think that's going to happen sooner than later. It's already the beginning of March. The pace of vaccinations, at least in the UK and the US, is really very strong. I think in Asia, it's also pretty strong. And I'm hopeful, even though EU has been pretty slow, that the next 12 months will pass quickly. And towards the end of this year, we'll be able to start doing those tours again, and transaction volumes will again increase. It's been remarkable how much people have been comfortable doing with either tours done by a local agent walking around, with a camera video screen up, or how much has been done with Google Maps and imaging. So there has been a remarkable amount done, but to really get comfortable with those big deals, I think you need to have free flow of people and that kicking of the tires. But maybe I'm old school. I don't know if my young analysts would say the same thing.
Well, you talking about extensions to exclusivity does remind me of one of the first deals that we did together at the St. Ermin's Hotel. And it was, I guess, 10 years ago. We had a volcano clause, which for those that don't remember, there was an ash cloud that erupted from Iceland, and you couldn't travel for around 2 or 3 weeks. And, you know, as a result, particularly on an early investment for you, naturally, very important as a reputable private equity house to make sure it's all done right. And if you couldn't get to the meetings that had to be held in certain places, it was going to be a problem. So I remember very well how we had to write that into the agreement. And so that, you know, that was quite fun and certainly quite bespoke. And thankfully, we haven't had to use the volcano clause again. But we are seeing, obviously, COVID-19 clauses and stuff like that. But yeah, I mean, I think look, that's really terrific, Anna. It's really great to get your thoughts on that. I mean, I think as we look forward, one thing that has, you know, some positive, it's clearly been super challenging for so many people on so many levels, homeschooling or, you know, deaths. You know, it's just, you know, it's been really, really hard for so many people. But, you know, there's also some good has come out of this in terms of it's shown the resilience generally of people and how governments have been able to support things, and we've been able to keep things on track. And as we go back to the office, you know, one of the we had sort of moved to a model of agile working where, you know, you could work from home remotely. We're in the client service business, so if you need to be in, you need to be in. But I think one of the things that has happened over the last year is there's been much more sort of acceptance that we may have to do a call on a video, and we won't necessarily have to get on a flight to go to Korea, Singapore, or wherever it might be. And, you know, that's a good thing because as we're all trying to also reduce our carbon footprint and be sensitive to environmental issues, you know, that's a positive that comes out of this. But equally, face-to-face interaction, there's no substitute for that. And I certainly look forward to the day where you and I can meet physically and over a coffee or a lunch or dinner, as we used to do, you know, not so long ago, but it seems a bit of a distant memory right now. Anuj, thank you so much for your time. I know you guys are super busy. Congratulations on your continued success. And I hope very much that we'll be able to be in touch soon in the same room, shaking hands without masks.
Yeah, well then. Very good. Thank you, Ciaran.
Okay, thanks, Anuj. Thanks. All the best. Cheerio. Bye-bye.